I'm John Hanna for CDTV.net, and we have Jerry Nicholas joining us here. Thanks for joining us, sir.
My pleasure, John. Nice
All
to be here.
Oh, thank you. Well, first of all, let's try to get to know you first. Tell us about your background, sir.
Well, currently I'm the Chief Investment Officer at Brinton Eaton Wealth Advisors, which is a full-service wealth management firm, national firm, but based here in Madison, New Jersey. Been with the firm about 9 years. Prior to that, I spent 25 years with the management consulting firm Towers Perrin, and there I led the global risk management practice. Before that, I was an actuary.
Okay. Now, where did the book come about? Let's talk about the name of the book first, and then you tell us a little bit of the background about it.
Sure. The book is Asset Allocation for Dummies. It's part of the John Wiley For Dummies series, and it was published in May of 2009.
Okay, and the reason for this book is because you wanted to help out more people by giving them some tools of how to allocate their assets?
Yes. As far as investment advice goes, there's lots of bad advice floating around out there, and I thought it might be useful to provide individual investors, average investors, with some very sound scientific advice that professional investors follow and that they can follow themselves to good effect.
Right. I remember in the old days when I used to trade, I would trade like one area on it, one sector, one industry at a time. So first of all, that's a big mistake that I realized so far. So it's kind of like one of those things like 10, 15 years ago when I was doing my trading for my own personal account. I'm looking at myself like, why did I ever do those stuff? So hopefully books like this could help out people allocate their portfolio, right?
Absolutely, yeah. I mean, you hit on one of the prime mistakes that people make is they tend to overconcentrate when left to their own devices. Tend to overconcentrate their assets in one or a small number of what we call asset classes, and the real trick is to diversify among several asset classes that don't all move together.
Okay, so when people see asset allocation, they're thinking, oh, I need to have like $1 million or $100,000 or even $50,000. Some of the retail investors out there are just playing around with like $20,000, $25,000. They don't have that kind of movement with regards to trying to separate their portfolio. What are your recommendations for them?
The benefits of asset allocation can be delivered to a portfolio of any size, as big or as small as you can imagine. So portfolios as small as 5, 10, 25,000 can still benefit from asset allocation, and the primary reason for that is the proliferation of mutual funds and exchange-traded funds that allow you to own a small piece of a very large basket at a very low cost.
So there you go. See, because like I said before, all of this information are not pretty much well known out there, and thank goodness for people like Wiley Group and the For Dummies series is that the company makes it more easy to understand some of this really advanced way of doing some investing in all the other Dummies book series out there. So what is the first step for people? Let's say, for example, I mean the big investors, they already are managing their money pretty well with $1 billion or even $100 million. They're already doing something right with those stuff. So for people,
presumably,
right? Until we see another news about some big hedge fund company, some fund company kind of like collapses and all that stuff. So
right.
So what do you tell initially on the book when people start reading the book? What do they need to know firsthand?
Well, first, just to follow up on your earlier comment, this For Dummies series, as you know, is a very large series. It covers financial topics as well as yoga, motorcycle maintenance, you name it.
Yeah,
It's a For Dummies book about it. But the kind of open secret about these For Dummies books is, even though it's in very simple, easy to understand language, the concepts are very deep and can be very sophisticated. And in my prior career as a management consultant, just about every CEO or CFO's office I was in had a For Dummies book on one topic or another on their bookshelf. And I'd like to think that asset allocation for dummies is along those lines too. Very simple, easy to understand, but very sophisticated investment concepts that a lot of professional investors, at least the good ones, follow. So the first thing is, well, actually, let me describe a little bit how these For Dummies books are structured, and that will help people navigate their way through the book. The introductory chapter is a miniature version of the entire book. The introductory section, which is several chapters, is just a expanded microscopic view of the entire book, and then the entire book goes into much greater detail on each individual subject. So it's like a nested telescoping kind of structure of the book. So you could start at the first chapter, get a broad overview, read the first section, get a broader overview, and then dive into any particular area that you like after that, that you need a deeper understanding of. So when you first pick up the book, I would direct you to right to chapter number 1, and that'll give you the broadest possible overview.
Okay. So when designing, I want to talk one strategy before we finish up the first part here. What is the most common mistake when people allocate their assets?
Is they overconcentrate, and not just only in one stock, but perhaps in one industry group. They may think they're diversified. They might have half a dozen or a dozen different stocks, but maybe they're concentrated in, say, the energy sector. So the price of oil would send their portfolio in one direction or another, and they don't have anything else in the portfolio to counterbalance that. So I would call that mistake number 1, overconcentration, whether they're aware of it or not.
Okay, and like you said earlier, it's like focusing on one area, even though like people think that they are diversified, but then again, it's not balanced enough that if some event happens in one area of their portfolio, then it kind of collapses the whole portfolio.
That's exactly right. You want a portfolio that mixes different assets together, different in the sense that some zig while the others zag, so that it maintains its value across a number of different economic and market environments.
Okay. Well, let's define some of the assets overview right now that they can diversify into.
Well, the 3 broad asset classes that we start with are stocks or equities. Second class would be fixed income or bonds. And the third are what we call alternatives, which are essentially everything other than stocks and bonds. So things like real estate, commodities, simple hedge funds, and things like that. Those are the 3 broad asset classes. Now, you notice I didn't include cash. Some folks may consider cash an asset class. I don't, and my firm doesn't. It's not really something to invest in. It's something to hold for short-term obligations like rent, mortgage payments, groceries, things like that, so for liquidity purposes, but it's not really an investable asset. So the 3 major asset classes, again, are stocks, bonds, and alternatives, which are really designed to do that zigging while the stocks and bonds are zagging.
Okay. Well, we're going to end up the part 1, and we're going to go with part 2 next. So where can people find you?
The easiest place to find me is on the web. My firm's website, www.brintoneaton.com, BRINTONEATON, brintoneaton.com.
Alrighty, great. And that's Jerry Michaelis, and I'm John Hanna for CDTV.net.